and I'm not sure which one this is, but an oscillator, and okay, the market's overbought here, hence vulnerable. Okay, is the market oversold here? Let me see. This is either, this might be RSI because it looks like it's 30 to 70. Do you have it on, what is it? I think it might be RSI. It's not, we know it's not stochastics, it's probably RSI. It is the RSI, definitely. So is the market overextended with that second high wave candle where I had the word oversold in question mark? Is it overextended on the downside? No. That high wave candle is likely not going to be that important. This other high wave candle, is the market oversold? Yeah. The market is more likely to rally with that. And then I don't know if it's quite a bullish engulfing pattern after. But this is one very easy way to do it. If you use oscillators, throw your oscillator on, see if the market's overbought or oversold, and then see if you get a candlestick signal confirming it. Okay. One way that the Japanese, and this works really well in the Forex markets, one way that the market can be viewed as overbought and oversold is by looking at record sessions. A record session is when the market, record session high is when the market makes a higher high. And we're looking at the top of the upper shadow. So first, the market has to make a new low for the move. And then every time it makes a higher high, not the real body, but the shadow, the top of the upper shadow, every time it makes a higher high, we count that as record session 1, 2. Now you see between 2 and 3, it didn't make a higher high. So it's not record session 3. And you go on. And generally between 8 and 10 record session highs, the Japanese will say the market's overextended. You'd view that as overbought. And that works pretty well, anywhere from 7 to 12 in the Forex. A lot of the Forex markets, it works pretty well. So you could view this as gauging if the market's overbought or oversold. So let me show you an example of this. And this works with record session lows also. Okay, we're going back to slide 152. I'll show you something interesting. So the market made a high here, and then you start counting lower lows. So this is a lower low. That's 1, 2, 3, 4, 5, 6. All right, so we have 7 lower lows. It's getting pretty close to 8. So the market's getting a little overextended. Okay, that would be 8 record session lows. But let me go through the count. What's that? The next one is 8. Oh, 8. Okay, 8. Okay, so she was saying, good point. The next one was 8. I didn't even see that. So let's look at an example here. First, we have to find the low for the move. You don't know it's a low until the market starts rallying. Then you look at the higher high. That's 1, 2. You'd see between 1 and 2 why it wasn't 2. The market didn't make a higher high. Now, I have not tried this for intraday. I've done this on daily and weekly. Okay, so for those who trade intraday, I haven't tried this yet. So some of you may want to experiment. And here we have 9 record session highs. Now, all the record session highs do is set up an alert. We need to wait for bearish candlestick signal to really turn negative on this. This is telling us the market's overbought. Remember, like an oscillator tells us the market's overbought? But the real turning signal comes only with confirmation of the candles. So what came after candle session, record session 9? The black candle wrapping around like 100 white candles? Right, the bearish engulfing pattern, which became a resistance area. Okay, so here are some record sessions, again, for you to take a look at. You could say record session 10 on the downside. After 8, we had a hammer, so you start thinking maybe it's a bottom reversal. Now, the reason I wanted to show you this slide is to bring out an important aspect about the record sessions. There cannot be more than 4 or 5 lateral candles, because what's going to happen is, let's say during the advance in these red numbers, like say between 5 and 6, the market trades sideways for like 4 or 5 sessions. Isn't that relieving the overbought condition? Right? By trading sideways, the market's not overbought anymore, so you have to start the count all over again. So let me show you a case in point. So record session 9. What would get us nervous about record session 9 in the red? What candlestick signal? Dark cloud cover. Yep. All right. So you say we have a dark cloud cover in an overbought market. So let's look. See, we're starting the count all over again. The high of the dark cloud cover made a pivot high. We start making lows, 1, 2, 3, and see what happened here? It trades sideways. If the market makes a new low after that, you don't say it's record session low 4. You start the count all over again. So what you have to do here, and it shows here, hasn't made a lower low. So what you have to do is start the count over again.
Steve,
Yes?
bottom 5 and 6, why isn't that a repetition high?
Okay, which one between? Oh, it should be. It should be. Okay, the question is between 5 and 6. It should be. I just didn't put it right. So it's actually 10 record session highs. And I wanted to see if anybody would catch that, so I did this on purpose. Yeah, right. You believe it. Yeah. And once again, when there's about 4 sessions or so, we start the count all over again. Okay, we're going to look now at intraday candles. And one thing that was mentioned before is that we have to be more flexible with intraday. And this is true with non-Forex, obviously, as well as Forex, is because the opening and closing on an intraday chart within the same day are almost always going to be the same. So this could be a Forex market, a stock market, it doesn't matter. If the opening and closing are the same, I would view this as a bearish candlestick signal, as a bearish engulfing pattern. Now this is for intraday traders, which is probably about half of you. What I strongly suggest is looking at the daily charts. I know you quiver when I say that. Look at the daily charts and use that as use the support and resistance areas, the important support and resistance areas on the daily chart, and throw them onto an intraday chart. And if you get a candlestick signal in your intraday time frame confirming the support area set by the daily chart, pull the trigger. And let me show a case in point. Okay, and don't worry about the text up there. Essentially what we're saying here, this is a daily chart. And on February 27th, the market is pulling back to a support level. Now what we're going to do is, and look how the market rallied after the 27th. What we're going to do is look at February 27th on an intraday chart. But what I've done is take that red line from the support area by the 2 bullish engulfing patterns, essentially. I'm going to throw that red line at 137.07 onto an intraday chart, which I did here. And right near that support area, the market formed a piercing pattern. This is a very valuable way of increasing